Good day, everyone. Today, we will be embarking on a deep dive into Nigeria's transfer pricing documentation requirements as stipulated under the Income Tax Transfer Pricing Regulation 2018. This regulation, introduced by the Federal Inland Revenue Service, was designed to align Nigeria's transfer pricing regime with the international guidelines issued by the Organization for Economic Cooperation and Development (OECD), specifically the 2017 OECD Transfer Pricing Guidelines and the Base Erosion and Profit Shifting Action 13 (BEPS) recommendation. So, with globalization increasing the presence of multinational enterprises across multiple tax jurisdictions, transfer pricing regulations play a vital role in ensuring that cross-border transactions are fair, transparent, and in line with the arm's length principle. So, today we will be looking at Module 5 transfer pricing documentation requirement, which is a three-tier approach. So today we will cover transfer pricing documentation requirement, a three-tier approach, country by country reporting, key obligations and penalties, transfer pricing declaration, disclosure and incorrect disclosure rules and penalties, exemptions and extensions, provision for small taxpayers, penalties for non-compliance, that is consequences of failure to comply, best practices to ensure accurate and timely compliance. So those are the things we'll be looking at. So first, let's start with the overview of transfer pricing documentation requirements. So transfer pricing documentation requirement, we'll be looking at the overview of the contemporaneous documentation under the 2018 transfer pricing regulations. So connected person now, that is companies or entities involved in controlled transactions, that is transactions between related entities. They are required to maintain contemporaneous documentation. This means that before the due date for filing income tax returns for the year in which the controlled transaction occurred, documentation must be prepared and maintained to demonstrate that the pricing of the transactions adhere to the arm's length principle. The arm's length principle requires that all transactions between related parties, such as subsidiary of the same parent company, be priced as if they were conducted between independent, unrelated parties under similar market conditions. This ensures that profits are allocated fairly across jurisdictions where the value is created, thus avoiding profit shifting to low tax jurisdiction. So this framework is designed to ensure that tax authorities have sufficient information to assess transfer pricing risk and make informed decisions. So the key objectives of this transfer pricing documentation requirement is transparency, provide clear and comprehensive information about the multinational enterprise pricing, transfer pricing policies and practices. Compliance, ensure adherence to local and international transfer pricing regulations. And risk management, mitigate the risk of transfer pricing adjustments, penalties, and disputes. So now let's look at the structure of the transfer pricing documentation. The OECD BEPS Action 13 introduced a three-tiered documentation structure which Nigeria adopted. This approach ensures comprehensive and consistent documentation across all tax jurisdictions in which a multinational enterprise operates. So the documentation consists of master file, local file, country by country reporting. So for now, let's look at the master file and the structure and content. The master file provides a high-level overview of the multinational enterprise global business operations, financial arrangement, and transfer pricing policies. It is intended to give tax authorities insight into the overall transfer pricing strategy of the group. The master file should be consistent across all jurisdictions and must contain sufficient details to allow tax administrations to assess transfer pricing risk. So let's look at the content of the master file. 1. Organizational structure. A detailed chart of the multinational enterprise legal and ownership structure showing all related parties and geographies where they operate. Business description and overview of the key profit drivers within the multinational enterprise, including the supply chain for its 5 largest products or services, or those contributing more than 5% of global turnover. So, the overview of the multinational principal activities, significant drivers of the business, profit, and key geography market is also very, very important. The description must also include details of any significant business restructuring, acquisition, and acquisition during the financial year. So let's look at the intangibles now. Information regarding the multinational enterprise strategy for the development, ownership, and exploitation of intangibles, e.g., the patent, trademark, and brand names. This section should also list important intangible assets, details of intra-group agreement concerning intangibles, and the location of research and development facilities is also very, very important. Intercompany financial activities. Details on how the multinational enterprise group is financed is very important, including financing arrangements with both related and unrelated third parties. This section should also describe the transfer pricing policies applied to related party financing. Then we'll now look at the transfer pricing policies. So a summary of the multinational transfer pricing policies and strategy, including a description of the choosing transfer pricing method, is very, very important. Let me also add financial and tax position. So consolidated financial statements of the multinational enterprise and details of any unilateral advance pricing agreement or tax rulings that the group has in place with various tax authorities should also be included. And exactly what is the purpose of the master file? The master file is designed to provide tax authority with an overview of multinational enterprise global operations and transfer pricing strategy, making it easier to identify potential transfer pricing risk across different jurisdictions. So now we look at the local file. The local file provides more detailed information about the specific intercompany transaction in each local jurisdiction. Unlike the master file, which provides a global perspective, the local file is specific to the local entity operations and transactions with related party. So now let's look at the content. Description of the local entity. Now this section should describe the management structure, business strategy, and key competitors of the local entity. It also includes details of any changes in strategy during the year. So control transaction, a detailed description of each controlled transaction, including the nature, value, and terms of the transaction, identification of related parties, and copies of material intercompany agreement is very, very important. Transfer pricing analysis, a comprehensive analysis of the selected transfer pricing methods or a selected transfer pricing method applied to each controlled transactions. This should include a comparability analysis, a description of benchmarking studies, and any comparability adjustments made. So it is very, very important to look at that. The financial information also, the local entities audited financial statements or unaudited, if audited statements are unavailable, along with a reconciliation between the financial data used in the TP analysis and the financial statement. Let me just add one more thing we go to the country by country reporting. So let's look at value chain analysis too. This unique addition under the Nigerian transfer pricing regulation requires multinational enterprise to include a value chain analysis showing the flow of goods, services, and capital within the group and the contribution of each party involved in the controlled transaction. So under the local file, you should please add the value chain analysis. The value chain analysis is also very important. It's a unique addition under the Nigerian transfer pricing regulation, which requires multinational enterprise to include a value chain analysis showing the flow of goods, services, and capital within the group and the contributions of each party involved in the controlled transaction. Let's also look at the purpose of it. The purpose of the local file is to provide tax authorities with detailed information about how transfer pricing practices are applied at the local level. It serves to justify that the pricing of local intercompany transactions complies with the arm's length principle. So it is also very important. So now let's look at the country by country reporting. The country by country reporting CBCR is the third tier of documentation required under the Nigeria's 2018 transfer pricing regulation. It is designed to provide aggregated information on multinational enterprise, global operations, profit, and taxes paid in each jurisdiction, allowing tax authorities to perform a high-level risk assessment of the multinational enterprise transfer pricing practices. So let's look at the content of it. The contents include the overview of allocation of income, taxes, and business activities. So revenue, profit, and tax paid. The CBCR must include the total revenue, profit before income tax, and income tax paid in each tax jurisdiction where the multinational enterprise operates. Number two, number of employees and tangible asset is also very important. And also the list of constituent entities. But let me talk about the number of employees and tangible assets. Multinational enterprises are required to report the number of employees, tangible assets, and retained earnings for each jurisdiction. So entity business ability, a list of all the entities, that's the list of constituent entities now, a list of all entities within the multinational group, their tax jurisdiction, and a description of the business activities conducted by each entity. So any other additional information that the multinational enterprise consider necessary or that the tax authority require to facilitate understanding of the reported data should also be included. Now, before we move to the best practices for transfer pricing, let me talk about the filing requirements. Multinational enterprises that meet the 160 billion naira or 750 million euros revenue threshold are required to file the CBC report annually, no later than 12 months after the end of the financial year. And now, the purpose of the CBCR is that it provides tax authorities with a bird-eye view of the multinational enterprise global operation and helps them assess whether profits are aligned with economic activity in each jurisdiction. So this allows authorities to identify profit shifting risk and ensure proper tax compliance. So any multinational enterprise that meet the threshold of 160 billion naira or 750 million euros in revenue threshold is required to file the annual CBCR report not later than 12 months after the end of the financial year. So within 12 months, not later than after the end of the financial year, they are required to file CBCR reports. And the purpose of this is that it gives the tax authorities an overview of the multinational global operation and it helps them to assess that. So before going to best practices again, there are some other things that I would like to look at. Let's look at the penalties for non-compliance also. Non-compliance with the 2018 transfer pricing regulations attracts significant penalties, which are intended to ensure that connected persons maintain transparency and accurate reporting. So it is very, very important that TP documentation submission penalty. If a connected person fails to submit transfer pricing documentation within 21 days of a written request from the FIRS, a penalty of 10 million or 1% of the value of control transactions, whichever is higher, applies. Additionally, an extra penalty of 10,000 naira per day is imposed for each day the failure continues. These are very, very stringent penalties. Late filing of the CBCR2, failure to submit the CBCR by the due date incurs an initial penalty of 10 million naira. Then an additional penalty of 1 million naira per month is imposed for every month of default. Of every month the default continues. Then filing incorrect or false CBCR also results in a penalty of 10 million. Then failure to provide notification. So even if you don't meet that required threshold, you're supposed to provide notification. So if a constituent entity fails to notify the FIRS of its role as the ultimate parent entity or surrogate parent entity, a penalty of 5 million naira applies. Then an additional penalty of 10,000 per day is imposed for each day the failure continues. I would also like to discuss the exemptions and extensions of submission for connected person whose total value of control transaction is less than 300 million. So what I'm saying here is that there is an exemption from maintaining contemporaneous documentation. That is, if the total value of your control transactions is less than 300 million, there is an exemption for you in maintaining contemporaneous documentation. However, Federal Inland Revenue Service reserves the right to issue a notice demanding the submission of documentation within 90 days if deemed necessary. Extensions may be granted for transfer pricing declarations or documentation submission. However, if the connected persons fail to meet the extended deadline, the penalties will be imposed as if no extension has been granted. So now we can talk about the best practices for transfer pricing documentation. So to mitigate risk and ensure full compliance with Nigerian transfer pricing regulations, connected persons should adopt the following best practices. So we'll be looking at consistency, maintain consistent and accurate documentation. One need to ensure that the information provided in the master file, local file, and CBCR are consistent across all jurisdictions. They are consistent across all jurisdictions. Regular update documentation to reflect changes is also very, very important. Conduct a comprehensive analysis. So perform robust functional and comparability analysis to justify the selection of transfer pricing method used. Use reliable and up-to-date benchmarking data to support transfer pricing decision. Then the third one is proactive engagement with tax authorities. Engage with tax authorities to discuss transfer pricing policies, documentation, and address any potential issues. Also consider seeking advanced pricing agreement to gain certainty on transfer pricing practices. Now, implement robust internal control. So one need to develop strong internal controls to ensure that transfer pricing documentation is prepared, reviewed, and submitted on time. Then train relevant staff on the importance of compliance with TP regulations and the company transfer pricing policies is also very, very key. So let's look at a case study. Now, with respect to this case study, we have XYZ Corporation, a multinational enterprise with operation in different countries. Now they have a transfer pricing audit by the tax authority in country A. Now, the audit focused on the pricing of intercompany transaction between XYZ Corporation and a subsidiary. So, implementation of best practices. XYZ Corporation maintain a detailed master file that provide a comprehensive overview of its global business operations, transfer pricing policies, and intercompany financial activities. They also maintain adequate local file, and they maintain the CBCR reports. So the audit resolution now, which means the outcome of the audit, due to the detailed and consistent documentation provided by XYZ Corporation, it facilitated a smooth audit process and demonstrated compliance with transfer pricing regulation. And the outcome also reduced transfer pricing risk. The comprehensive analysis and proactive engagement with the tax authorities help mitigate the risk of significant transfer pricing adjustment and penalties. So, just to conclude, Nigeria's transfer pricing regulation 2018 placed significant emphasis on the maintenance, transparency, and submission of transfer pricing documentation. So the introduction of this three-tiered documentation structure, master file, local file, CBCR, has brought the country in line with international best practices, ensuring that connected persons accurately report their control transactions. Adhering to these documentation requirements and implementing best practices can help connected persons manage transfer pricing risk, avoid substantial penalties, and remain compliant with both local and international tax regulations. Thank you for your attention.